Hello and welcome to our group presentation. Throughout this video, we will be going through the concept of inventory turnover and inventory days of supply. Inventory turnover is a central inventory management benchmark for retailers. It is used to measure the amount of a business's inventory sales that have been sold and replaced during a specific time. There are times where businesses experience a weak sale and a strong sale throughout the year. This indicates that when a company has weak sales, there is a chance that the company will face excess inventory while products are not being sold to catch up on upcoming supplies. Strong sales can also result in a possible inventory shortage, meaning that the products being sold cannot keep up with its supplies. However, there are challenges when using inventory turnover. The first challenge is about management. Management has a direct effect on an inventory turnover if a warehouse is inefficient and struggling to move goods quickly enough as expected. Second challenge is seasonality. It is where demand is led by the seasons. In other words, demand is not going to be steady throughout the year. And for our next speaker, we have Tian Kun for the inventory days of supply.
Inventory turnover days refers to the number of days a business takes for acquiring inventory to consuming and selling. It is calculated as the ratio of the cost of sale to the average inventory over a period of time. The fewer the turnover days, the faster the inventory will be realized. The short the time inventory take up capital, the more efficient the inventory management work, which means that the company is selling well. The formula for calculating inventory turnover days is inventory turnover days 365 divided by inventory turnover times. The next part is Xingchen's speech on relationship between days of supply and inventory turnover.
Inventory turnover and days of supply are both essential index of a company's management level in a certain company. Company with lower days of supply rate means it is doing well selling products and having acceptable capital control. Meanwhile, inventory turnover ratio is quite the opposite. Company will need to keep it at a relatively high number. It is an efficiency rate that helps a company measure its ability to use assets to generate income. Besides that, inventory turnover shows how quickly a company can sell its inventory. Meanwhile, days of supply look at the average time a company can turn its inventory into sales, meaning days of supply is essentially the inverse of inventory turnover for a given period. And our next team member will discuss about the importance of inventory turnover and days of supply in inventory control.
Inventory control is the process of optimizing inventory storage to ensure the desired inventory level required and fulfilling customer orders on time. So inventory turnover and days of supply is crucial to enable how quickly inventory can be sold and replaced in a given time period. Sales will never be 100% linear, so you must constantly measure changes over time to adjust the rate and quantity of replenishment as to save inventory costs. It helps to link upstream activities of purchasing and manufacturing to downstream activities, sales, and product demand to prevent bottlenecks, speed up processes, identify unsellable or outdated items. So this is our presentation. Thanks for watching and listening. Hopefully you are enjoying for this video.